Okay, good day everyone. So I'm going to discuss about ratio analysis based on the case of Linde Bangladesh Limited company. So this company was compared its ratios with the Biximo Pharma, a similar type of industry. So in ratio analysis, we have liquidity ratio, asset management ratio, debt management ratio, profitability ratio, and market ratio. So when we say liquidity ratio, it determines the firm's ability to meet its debt, ability to pay its debt when they become due. This ratio establishes relations between cash and other current assets. Commonly used ratios are the current ratio and the quick ratio. So current ratio is the measures it will measures the company's ability to pay of its current liability. Here we can see that current ratio was highest in 2014 and also 2010 and compared to other years. So actually it is decreasing every year from 2010 to 2012 and again increased in 2013 to 2014. It is considered standard of current ratio to be 2:1. A current ratio 2 means that current assets are sufficient to cover for twice the amount of company's short-term liabilities, and then it is considered to have good short-term financial strength. We can see that the ratios are better than the benchmark of 2. So it denotes that the liquidity of the company is doing well. However, high current ratio means that the companies do generate cash, or maybe it is utilizing its assets properly. So it might be good sign for the company. On the other hand, compared to most recent year current ratio of Baxemco Pharma, so here the current ratio of Baxemco Pharma in 2014, this ratio is also better than that. Therefore, in a concluding note, we would like to say company has enough current assets to make the company short-term to make the payments of short-term liabilities. So next one is the quick ratio. Quick ratio is one of the important ratio in finance and the most conservative ratio in calculating liquidity position. A company with a quick ratio of less than 1 will find it very difficult to pay back its current liabilities. It is bad signs for investors. Here, as you can see, that is gradually decreasing from 2010 to 2012 and increasing from 2013 to 2014. In 2012, significantly changed because in 2012, more inventories purchased compared to other years. However, the decrease does not have that much negative impact as because the quick ratio was better than the benchmark of 1, which is good. Therefore, the company's liquidity position is satisfactory according to the benchmark analysis. On the other hand, here, the compared to quick ratio of Baxemco Pharma, which is 1.25, Linde's quick ratio 2.17 was better than that of. So, overall comments, the company's current ratio and quick ratio suggest that its liquidity condition is good. With its current assets, the company is capable enough to meet the current liabilities. So, let's move to asset management ratio. So when we say asset management ratio, it's the activity ratios are used to evaluate the competence, competence or efficiency which the company manage and utilize on its asset. This ratio also calls the turnover ratios because they indicate the speed with which the assets are transformed or turned over into sales. A proper balance between assets and sales generally reflects on that assets. So the assets management ratios are as following. First is the inventory turnover ratio, days sales outstanding DSO, and fixed asset turnover. So let's start in inventory turnover ratio. So inventory turnover ratio measures how fast the inventory become cash or accounts receivable. If the turnover number is more than the company's position, is good. In 2010, it is 5.14 times, 2011, 3.46 times, in 2012, 3.14 times. In those consecutive 3 years, the inventory turnover rate has decreased gradually. But in 2011, the rate of inventory has decreased drastically from 5.14 to 3.46. The reasons for such a decrease is Linde piled up too many inventories in 2011. They had 361,478 in 2010, and in 2011 they had 657,315 inventories in hand, which is too high, but the sales was not too high in compared to this. In 2013, here, three, in 2013, which is 3 point, the inventory ratio is 3.81 times, the rate increased compared to the last 2 years. But even that year, the rate wasn't even near to the rate of 2010. Again, in 2014, the rate full and decreased to 3.29. Here, we see the turnover is decreasing over the time except in 2013. On the other hand, we can see that this ratio was higher than compared to Baxemco Parma. It might be holding, which is 2.45. And it might be holding excessive stocks of inventory in recent year, but the rate is higher than the compared firm, which indicates that their inventory management is good. Okay, so let's check the DSO, Days Sales Outstanding Ratio. In this O, it is the measures of number of times per year, which the average amount of sales is collected and transfer the cash amount. Here, we see that in 2014, the company took, here we see that in 2014, the company took 42.27 days to collect its sales. Here, 42.27 days to collect its sales receivable. In 2013, let's see, it took 33. It took 33.79, round off to 33.80 days to collect the sales. In this case, the collections performance of recent year is getting worse than that of previous year. The reason might be they are increasing their credit sales in last 2 years. So, the company management is not performing efficiently to collect the sales regularly. Again, compared to Baximo Parma here, which is 44.89 days, it's and Linde's company is 42.27, is not it's is not poor. So we conclude that the firm should to be more serious in collections of receivables. But the DSO is good compared to Baximco. So for this increased DSO, the reason might be that the company is focusing more on their sales or clients and increasing their DSO, but it's not high in compared to the other companies. And fixed asset turnover ratio. So in fixed asset turnover ratio, it shows that the company has been more effective in using the investment in fixed assets to generate revenues. So here, the company is not in a good position because the fixed asset turnover ratios were decreasing. As you can see, this is decreasing. In the 2013, it is slightly better than previous year, but not like as 2010. But again, in 2014, it decreased. It shows more or less ups and downs through the 5 years, which indicates that the business has invested in the fixed assets, but sales did not generate as much as the fixed assets. However, when we compared it to Basemco Pharma, which has 0.54, in that case, it's 2.52 better than that of. Therefore, the reasons might be the presence of value of growth opportunity. And overall comments, the company is focusing on growth, thus they are not doing well in terms of managing its fixed asset and inventory due to poor sales promotions. However, to improve the DSO or day sales within a short period, the firms should be more punctual in its collections of credit sales. Cash discount cash discount can be increased, and the result of this ratio are showing the present value of growth opportunity. So now let's move to debt management ratio. It is where show the leverage scenario of the company. The debt management ratio we can justify on the two ratios. Those are the debt ratio and the time interest earned, TIE ratio. So in debt ratio, it is seen that the company has started using in its capital structure from the year 2010, and it has both increased and decreased the portions of debt. In a sense that the company has taken debt as per their need. The more a company take debt, the lower will be the taxable income and get tax exemptions. However, since it is changing its capital structure by putting more debt in it, so it is matter of risk for the investors. Though an optimum level of debt portion is expected to get the tax advantage, and the EPS will be higher in 2013, which is 29.91% years compared to previous year, and compared to and so again compared to Baximo Pharma, which is 27.86%, the ratio is higher than that. So that means Linde Bangladesh Ltd is a highly leveraged one than Basemco Pharma. Okay, so let's move to time interest earned, TIE ratio. So the graph shows that the consequence of adding debt to the capital structure. As the company has started using not much debt, the ratio has started getting better. So this is very good news for the investors, because if the company have enough EBIT, then they pay the interest charges. But in 2012 is significantly lower than the other years. Because of the lower EBIT and higher interest expense compared to the other years. On the other hand, compared to the Baximo Pharma, which is 3.34 times, the ratio 639.35 times is also better than of. So, in overall comments, the company has started increased use of not much debt in its capital structure. As a result, in its TIE is getting better. So it is not much risky for the investors. On the other hand, it is lucrative for the investors as the EPS has increased in 2013 than that of previous year. Another one is we have profitability ratio. In profitability ratio, it represents the organization's ability to translate sales takes at different stages of measurement. The ratio measures profitability after considerations of all revenues and expenses, including interest, taxes, and non-operating items. This ratio specifies the capacity of the company to survive difficult circumstances, which might occur from a number of bases such as declining price, increasing costs, and declining sales. The profitability ratio we can justify on the 5 ratios. Those as the following: profit margin on sales, total assets turnover, return on investment asset (ROA) ratio, then financial leverage, and then also the return on equity (ROE) ratio. So here we show 4 ratios out of 5. Let's start on profit margin on sales. So in profit margin on sales is the percentage of selling price that turned into profit, whereas profit percentage or markup is the percentage of cost price that one gets as profit on top of cost price. While selling something, one should know what percentage of profit will he get on a particular investment. So the companies calculate profit percentage to check what is ratio of profit based on cost. A higher profit margin percentage is favorable profit indicator, and vice versa. This ratio helps the organization to fix their product price. If the ratio's minimum percentage then indicates the product market priced lower or product production costs high, here we see that the profit margin ratio was gradually decreasing in 2010 to 2012 from 20% to 12%, but it has gone up in 2013 and 2014. Wait, cut off. Okay. That can give wealth for the company. In 2012, it was lower than other years it because on this year net income was lower compared to other years. So on the other hand, here when we compare this ratio with Semco Parma, this shows better than that. From 13.63, the lending company is in 16%. So other profitability ratio is the total asset turnover. The total asset turnover is an indicator of the efficiency with which a company is deploying its assets. The higher the ratio, the better it is, since it implies the company is generating more revenues per take of assets. So, but since this ratio varies widely from one industry to the next, comparisons are only meaningful when they are made for different companies in the same sector. The ratio rose in 2011 and then gradually falls in 2012 to 2014, respectively. On the other hand, compared to Baximo Parma, it's much more than cut off. From 0.38, the company is 1.05. And then, third one is return on asset, ROA. So, it indicates return on total assets indicates how profitable a company is relative to its total assets. So it also indicates the management efficiency to utilize total assets to make profit. In 2010, it has been highest compared to the previous year, which is 23%, and again dropped to 16% in 2014. In 2012, ROA is lowest compared to 2000 compared to other years. Yeah, compared to other years. Because on this year, net income is lowest than other years. In 2014, here in 2014, it also lower because total assets of 2014 increased compared to 2013. But net income is decreased compared to 2013. So it can be said that companies generate return on the assets is not up to the mark compared to previous year. But compared to Baximo Parma, which is 5%, it represents better value than that of, which is 16%. Third one is return on equity, ROE. So it is the measurement of shareholders' wealth maximization. It indicates how much shareholders earn from their investment. The higher the ratio indicates higher the shareholder wealth maximization. So return on equity is highest in 2010. Return shows 33%, but this is gradually decreasing in 2010 to 2012 from 33% to 22%. It has gone up again, dropped in 2014. So up to 30% in 2013 and decreased in 2014. In terms of comparison with Baximo Parma, it's much better than that of, so it is good for the company. And overall, Linde Bangladesh Ltd has been a profitable company almost since its establishment and during the past few years. The profit margin ratio has improved a lot. However, in last couple of years, 2011 to 2012, profitability has gone down to changing economy and huge stock market crash. Here we see that all the profitability ratios are better than other firms like the Semco Parma. The ROA is better than other firms. In addition, when we calculate the profitability ratios, we find out that Linde Bangladesh Ltd was low leverage 1. This confirms the observations of exist management. The apparent of low leverage in terms of lower tax exemptions is evidential in profit promotion. These operations activities of the firm affected from better assets management and low average debt. So the last one, we have market value ratio. So market value ratio shows the market demand or the market scenario of the company. It can be measured by the help of the following two ratios, the PE ratio and the market value ratio. So let's talk about PE ratio. The graph shows an increasing PE ratio over the years from 2010 to 2012. But in 2011 and in 2013, the ratio decreased, but it increased in 2014 again. In the case of 2014, here, it means the firm is growing and the market price has increased than the previous years. It is good news for the investors that indicate that the firm gained more trust from investors. The company the compare company had also low PE ratio, which is 14.14 than the Linde 22 in 2014. This high PE ratio is truly describing the growth of the firm and describing the reason for the low asset management ratio. So let's move to market or book value ratio. So uh, the market to book value ratio has decreased over the time from 2011 to 2013. So it is decreasing. But it is increased again in 2014, but could not even match with the rate of 2010, which is not a good sign. It seems that the market lost trust from the company from the period of 2011 to 2013, and thus the company changed its policy, which we can see in its other ratio and in 2014. It again started to increase trust in its investors. However, still market value of Linde market value of Linde 5.23 is too higher than that of the market value of the compared company, which is the Basinco Parma had 1.03, which is good news for the company. Again, the market value of the share is higher than its book value, which is good news for the firm. So overall, one of the most important ratios to evaluate the performance of the firm is the price-earning ratio. Looking at the two ratios of market value, it can be concluded that in 2010, the market situation was good. But after the share market crisis in 2011, the ratios got poor. Although, good news is that market value of the share is higher than its book value and PE has increased than that of last year, which is actually reflecting the growth of the firm. The improvement may indicate that the firm is gaining some trust of the investors. So that's all. Thank you.